This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is the President and Chief Executive Officer of Equinox Funds, Bob Enck. He's overseen the overall operations of Equinox Funds since March of 2007. And for those of you that are not familiar with Equinox, they're pioneers in developing what they would call investor-friendly alternatives, such as the first multi-strategy managed futures mutual fund. Now, for those of you that might be immediately wondering, what does this have to do with my world? Well, first off, I love diversity. Number two, for those of you not aware, managed futures encompasses trend following. Perhaps 50% of the managed futures universe, perhaps much more, is derived from trend following strategies. So in the world of appropriate fund management, you will hear terms like managed futures and CTA. These are terms that have been around for a long time. Some people know them, some people don't. But as I note, often the root strategy is trend following. So that gives Bob and I quite a bit to talk about today. Plus, fund management, portfolio management, the appropriate portfolio for you, the investor, whether it's you, the individual investor, or you listening who might be an advisor to investors. Bob has some great insights from his catbird seat in the alternative space. I hope you enjoy this conversation with Bob Enck from Equinox Funds. I would love to know your first time that you saw something. And again, there's going to be other strategies in your world than just trend following. But I would love for your recollection of being exposed to trend following for the first time. How that happened. Was it explained to you when you saw it? What kind of aha moment did you have when you realized, oh, wow, the typical 60-40 buy and hold stocks, bonds, this is something different?
Yeah, that's a great question. For me, it's so memorable. It's clear as can be. We're here in Princeton, New Jersey. Years ago, probably 14, 15 years ago, two friends of mine, John Pallet and John Plimpton, started what's now Equinox Funds. I was friendly with both of them. And I was the guy in town that they would call when issues would arise. We'd quite frankly go meet for coffee. I was also the guy that they would hand literature to and say, hey, would you take a look at this? Let me know what you think. And at the time, I was doing more merger and acquisition type work. Didn't know anything about the industry, didn't know anything about managed futures or CTAs. What I learned was really from looking at their initial literature, and they had a concept called the perfect complement, which I thought was clever. From there, at some point, I got a call. They said, Bob, listen, we have a great idea how we can work together. At the time, I was doing kind of M&A advisory work. And so I thought, okay, I know these guys have gotten this from nothing to, I think they had maybe $300 million in assets under management. And I was thinking, oh, they're ready to sell the business and they're looking for a sell-side assignment for me. We get together and they said, Bob, we have a great idea how to work together. We need a CEO. We think you'd be the right guy. At that point, I dug in more. It wasn't the superficial, let's look at the literature. It was one of those where I took the prospectus of the Frontier Fund, which at the time was a multi-100-page document. It was, Michael, it was something like 600 pages, okay? Read it cover to cover, and I had a lot of questions. So I went back and talked with both John Plimpton and John Pallet, and John Pallet was just brilliant at educating me. And the aha moment came at that point where it is still one of the things I love about this industry. It still resonates with me as to what I love about it, and that's that the idea that you can make money going long or short, that it's global. You can make money in agriculture, metals, interest rates, equity indices, currencies. Why in the world is everyone focused just on stocks and maybe bonds? It's this concept that being able to short, being global, that incredible diversification that you get in this category. The light bulb went off and I was hooked. I loved it. I think now, and I thought then, that the category made so much more sense. And the other thing I thought that was really cool about it at the time is that the concepts within the category are they're elegant and fairly simple. When I explain to my mom what we do, it's not that complicated. She may not understand how Cisco Systems makes their widgets or how her iPhone works. But growing up in Minnesota, if you listen to the Minneapolis Grain Exchange reports, as we hear occasionally when I grew up, I think everyone understands the fact that there's long and short selling, there's hedging going on in, let's say, the grain market. I think everyone understands that if the weather is bad, guess what? The price of corn may go up. If there's a move in terms of global risk, investors move towards what they might consider safer currencies or what have you. The simplicity of how this category works and that true diversification, I thought was really cool from day one. It's interesting. It's such a good question because there was an aha moment for me, and I remember it vividly.
Let me keep you in that aha space, because not only would it just be the concept that you've had a chance to be exposed to back in the day, but you also, quite early on, got exposed to some of these very unique minds, some of these unique managers, traders that have been practicing these types of trading strategies that we're talking about for literally decades. Is there any story or a vignette you might like to share about an early meeting with any particular individual that really resonates or sticks out in your mind with you? Because you've really had a chance to be exposed to, and I feel lucky as well, to some really brilliant thinkers.
It's interesting. There's a lot of them. As I think back on some of the experiences, the interesting tidbit for me is, and reading your book, the memories of reading, Martin Lewick, who I've seen present multiple times, and he's just such a gentleman. Jerry Parker, who, you write about a lot. I'll tell you one kind of fun one for you is, and maybe you heard it, but we had a webinar with Jerry Parker. Naturally, we spend a little time on the big turtle trader history and all that because people love hearing that. But people also want to understand how CTAs make money. And Jerry does as good a job of it as anyone. Anyway, one of the last, I think it was the last webinar we did with Jerry, you got a shout out because I recommended your book to everyone online. I think we had 600 listeners, mostly advisors of some type, RIAs or financial advisors. I'd recommended the book to everyone, trend following book. It was one of those kind of smiling that, what, I'm sitting here as host. I'm kind of the MC when we do those, right? We usually have, let's say, a CTA, someone on our portfolio team, either Dr. Ajay Dravid or Dr. Rufus Rankin, and I really act as the MC and kind of ask the questions, kind of move along. I just find myself on such a regular basis. I'm sitting with folks that I consider legends that, I get to work with. We jointly present and or simple things, Michael, like training our sales team. We're lucky enough to have Mike Harris from Campbell will come in. Nagal Kalajian will come in. We just did a program up in Canada with Nagal on the panel. I know you've interviewed him a few times. Let's put all that aside, and I'll tell you the most interesting one. We had a program, actually we held it here in Princeton. We were trying to expose a kind of a mixed group of institutional investors and RIAs for the most part. And we're trying to go through the basics of how do CTAs make money? So think of it as entry-level CTA making money 101. We had a really cool back-to-back. We had a discretionary trader who traded grains, who was a farmer, talked about, I go down, I see what people are buying, I have a pretty good insight, and I make big bets. Don't get them all right, but I make big bets, and I trade as a discretionary trader. And this CTA tool we allocated, and it came off really well. Followed by one of the UK-based quants, who's purely systematic. They make money totally differently because they were both in a multi-CTA portfolio that we're offering. It was great to compare and contrast, but that was one of those where a lot of times in this industry, we think of the trend followers, the Campbells, the Chesapeakes, the Aspects of the world. But I think the interesting contrast with discretionary traders and systematic traders is fascinating, and it tells a lot, right? Because they make money in different time frames and they pair well together.
That's one of the things we're going to be diving into here is the notion of correlation and trying to find those streams of returns that are not correlated. Big picture, though, for the audience, let's establish your firm. Let's establish a baseline of starting, the growth. And if you're in an elevator and you're just, or, talking to your mom, what is the description of your firm other than saying, kind of a multi-manager, mutual fund and combining different hedge fund players into a particular vehicle? I mean, that's my kind of rudimentary way, but I'm sure you've got a better way to describe.
At Equinox, we like to think of ourselves as being a bit ahead of the curve. We're not big enough to muscle out in the marketplace a traditional long-only fund or anything that's not, in our opinion, unique and better. So we like to bring innovation to the marketplace. We feel like we've done a very good job of doing it. We got started, and this is before my time, so I had nothing to do with this. I helped manage it once I got here. But we got started. We brought the first daily liquid managed futures offering to the mass affluent investor. So we started a fund called the Frontier Fund. With $1,000, one could get into the managed futures category. Once again, daily liquid, daily pricing. It brought a lot of innovation. Part of it was it's easy to do that in this category because the markets that are traded are so liquid. We moved on from there to probably more of an area that people know us for now. We launched the first mutual fund, Mutual Hedge it's called, that accesses CTAs directly. It's a CTA-focused mutual fund that today has 17 different CTA strategies that are being accessed. We're moving from there to areas that we're a little bit more, excited about the innovation now, in that we look at the marketplace and think, okay, how do we help clients do a better job? We're basically saying we are an asset manager that is not just in the mutual fund business, but we're trying to bring bespoke portfolios to more of an institutional crowd. Think of us first as an asset manager with innovation, but also we want to bridge some of that experience that we have in the mutual fund arena into bespoke and kind of custom overlays and custom advisory assignments.
With all that you know, and you survey the landscape of traditional investments most people are involved in, the 60-40 split, stocks, bonds, this kind of long only, just hold it, set it, forget it, and that's just going to be good enough. At some stage of the game, you almost got to pull your hair out that that's still a mantra, that we still have not pierced that in a massive level yet. But we haven't, have we? I mean, you guys are doing a good job of it. A lot of people have been poking at the edges for decades, but we're still in a mindset to where, my gosh, these traditional CTA managed futures, trend following type strategies in terms of the investable assets, very small percentage.
Oh yeah, you've been doing your homework. I have to tell you, the biggest issue we have in the marketplace in terms of, let's say, raising assets and kind of evolving the market is advisors, institutional allocators, they just resist the opportunity cost of giving up equity returns. So you see it in 60-40. They diversify a bit, but at the end of the day, if you look at the risk metrics of a 60-40 portfolio, 90+% of the risk is still in equities. Think about that. You're 60% equities, 40% in fixed income, 90+% of your risk is still in stocks. The issue is, in a bull market, and we're in a long bull market now, as you know, advisors and allocators are very resistant to giving up their equity returns. It's also interesting. I look at, all right, if we can get them to go from 60-40 to, let's say, 50-40-10, you move the needle a little bit. And if you don't put more, at least 10% in, you're not changing your risk metrics all that much. It's helpful. A 50, 30, 20 moves it a little bit more, but the real issue that we're seeing is that I don't think this appetite for equities is going to change anytime soon. So we stepped back and said, okay, how are we accessing CTAs in our mutual funds?
Can I interject? The appetite for equities, that's driven by the financial advisors. I mean, I always kind of look at it and say, okay, we're long in an equity bull market. They're even more resistant to change. I think the sad thing is for investors is that those advisors, I don't know if they really care if there's another equity decrease of 50% because they all go down together and there's no real fear because, my gosh, if we drop 50%, Tom, Jim, and Eddie, we all dropped 50%. Do you see where I'm going? That's always bothered me, that this kind of groupthink is really awful for the individual investor.
That's such a good point. And it's not just the advisors, though. It's amazing how advisors will tell you that if equities are going up and they have, let's say, 10% allocated to alts and the alts are not keeping up, or alts are flat, or, wow, they might be down for a year. Clients come in and point to that and say, hey, why is this down? That's part of it. Then the other part is they feel like they cannot underperform their peers. You and I both know that what they really should be doing is rebalancing, but they generally have these built-in challenges. I'll tell you another interesting anecdote. Years ago at a child's birthday party with a friend who was running a very large fund for a very large asset manager in the long-only space, we're talking about, hey, how's your fund doing? This is late 2008. We're doing great. We're down 30%. I kid you not. I'm cross-eyed. Like, how can that be great? Their benchmark was down 33. And there's a lot of market out there that looks at the world that way.
There's a famous, at least I like to think of it as famous, Ben Stein saying that if you made money in October of 2008, you were doing something wrong.
No, exactly. And, it gets to that point about rebalancing and diversification and so on. We both know what CTAs did in 2008 and what happened thereafter, right? A lot of money came into the category in 2009 and 2010. Now I look at it and think, okay, we all know the equity bull market will not last forever. We all know that diversification works. At the end of the day, though, well, we're fortunate that our net flows are positive this year. For the most part, the industry, the flows are leaking out slowly out of the category. As soon as there's a hiccup in equities and the category is doing better, CTAs are performing, guess what? You know that there's going to be a follow-on effect looking in the rearview mirror. But what do you do?
Hey, let's talk about the allocation, because you brought that up a moment ago. Traditionally, typically over the decades, if investors that were kind of woken up a little bit or advisors were woken up, they might say, well, gosh, let's get 5 to 10% of your portfolio into alternative strategies like we're speaking about today. But 5 to 10%, is that what people really do? Are we really even getting to those numbers? And is 5 to 10% just been kind of the wrong thinking? Like, it's almost like begging folks to do something that's really good for them, but it's probably much better for them at a much higher number than 5 to 10%, isn't it?
Oh, yes. If you look at the data, if you look at the results of what a higher allocation to a non-correlated asset class with positive expectancy does to a portfolio, more is better. The challenge is giving up the tie to the current market conditions where your benchmark is, gee, how are you doing versus the S&P 500? That's a challenge. We look at that and say, all right, if 5% is not enough, and we believe that, all right, we put that out there, 5% is not enough. 10% is better. But at the end of the day, how are you going to get allocators to dial up their diversifiers to a level where it's really going to help the portfolio overall over the long term?
That's the challenge right there, isn't it?
It's a big challenge. And it really gets to that point of allocators are very resistant to give up equities in a bull market.
What are their exact reasons, Bob? I mean, what are the public reasons and what are the private reasons?
I think the biggest one is what you mentioned earlier. If equities get hit with the 30% drawdown, all of their peers are also experiencing the same drawdown, so it's okay. I also think it's the fear of, okay, if I don't keep up with the market when it's going up, am I going to look bad? Are my clients going to leave me? I think there's some of that, and I think there's a big component of education and understanding. We try to address that in our small way. We have this press play series on our website that has nice short vignettes. We put out white papers. We make available podcasts from people like you And then we've also sent out your trend following book to clients, basically saying, look, read this. You'll learn something.
Here, it's only 220,000 words. Read this.
It's great. But, at the end of the day, there's that educational component because they have to believe. Difficult part for us is kind of shifting that mindset. So part of it, of course we spend people that already are drinking the Kool-Aid and get it. They understand all this. And we're trying to make sure we do the best job we can to provide the best funds out there for them.
I would imagine as I bring up the advisors and a little bit stuck in the mud and no real need to help their individual clients diversify because if everything goes down in the S&P, they go down together and, country club memberships still stay the same, all that kind of fun stuff. So I assume it's not only a guy like yourself, your firm, Equinox, not only do you need to try and educate or sway or persuade the advisors, but it's also a matter of reaching out to the individual investors too, isn't it?
The way we do that is we don't go out to the individuals. We're not really advertising and so on, but we are going to folks like family offices, the direct allocators and so on, because we do think they care less about the short term, how am I doing versus the peer group, and care a lot more about how do I protect what I have, how do I expand what I have, how do I get better risk-adjusted rates of return. And that's something that we've been moving up in terms of our allocation of time and energy. The direct allocators and institutions are a bigger focus for us. We used to be focused mostly on the retail crowd, and now about half our business comes from what you'd consider institutional sources. I think it's been effective for us in that the time horizon, the comfort level with, yes, every asset class has drawdowns and diversification does work. Much like the CTAs with whom we're dealing with, there are a lot of fantastically well-educated and intelligent people in that crowd. It just is. The science behind portfolio management, the science behind, how trend following works and how a portfolio of diversifier works, it resonates with them. So we've been finding a little more success with that, and it's interesting to see our kind of business shift from almost purely retail to about half and half right now. And I suspect that we're probably going to be growing the institutional side more, or at least at a faster rate.
Let me reach back to something we just talked about briefly, which was we mentioned October of 2008, a great classic moment of a crisis hitting and alternative managers smashing record alpha out of a time where everybody else is in pain, and here the CTAs, the trend following traders, just do fantastically well. If we look at early 2018, we see a stretch where some might say, well, hold on, we had this really quick, sharp sell-off. Where was my crisis alpha? Why did I not get it this time? I want you to address that, but I think also the larger issue is the notion of correlation and the notion of perfection. The idea that we can have a one-to-one perfection that when something goes wrong in equities, statistically, we would have exact protection from the alternative side. It doesn't work like that. But why don't you give me your feedback on those points?
Yeah, it's interesting. So within the managed futures category, of course, we know that a lot of allocators, a lot of advisors move into the category for crisis alpha. We get that. And I think of the many reasons to be in the category, that's one helpful reason. We know that it's worked in multiple occasions over time. If you look at any of the big kind of global crises that we've seen, this category has done extremely well. Almost every time there's a global crisis, the category does well. The short-term little blips, when equities get hit hard for a month, maybe the short-term traders do well. You'll see that maybe the global macro players do well. But the trend followers, especially the longer-term trend followers, are not going to catch that short-term dip. If you think of how they make money, especially the longer-term focused models, they're not going to change their models immediately with a 5-day drawdown. Their models start to kick in and change over time. They often let their winners run and have disproportional returns with their winners. But the short-term setbacks, no one that really knows about the category expects the short-term benefits of trend following to kick in for, over days. But the long-term benefits are clearly there. But the other interesting tidbit is this. I know that you focus a lot on just trend following, but what you'll find in our world, what we try to do is get in our multi-CTA portfolios, a really deep blend. We have a product called Ampersand. We have one called Mutual Hedge that we're really focused on trying to get a vast amount of diversifying positive expected returns in one portfolio. So you're going to see, yes, of course, trend following, but we have some short-term traders, spread traders, systematic global macro players, discretionary global macro, and so on. With that, we fared better than most this year because we weren't solely dependent on trend. And we like trend. At any one time in the multi-CTA portfolios, trend is about 50% of the composition of the risk budget. But the other half are other strategies that are not correlated to trends. Much like you and I may be advocating to the marketplace that diversification works and that you need to have diversifiers in your portfolio and correlation's a big deal. We feel the same way even within this category, that correlation is important and having diversification within the category is critical.
I always look at track records and I think to myself, there's so much interesting data. And I know this is kind of boring for some folks, but if you just go take a couple managers that have been around for decades and you look at their month by month, that doesn't necessarily make today in 2018 feel comfortable. But when you can look at a manager and see the volatility in return, but the overall upward swing in returns over decades, that's such useful information. I mean, I know it's always Johnny come lately, what's going on for me right now, but if someone just pauses and they're a serious individual and they go back in time and look at these track records, and this is frankly how I got into this field, was just looking at these track records and saying, this is absolutely amazing data.
Oh, couldn't agree more. It's funny. There's a lot of things that we do that you'd consider marketing. The educational pieces, white papers, and so on. But, we're really doing that to educate for a very specific purpose. Say you should understand more about this category. We also publish something that's just pure data, right? We put something out, ctaperformance.com. It is not marketing. There's not a link to anything marketing in it. It's just data. And what it is month-by-month returns of a variety of CTAs. As you know, a lot of these CTAs, their trading strategy goes back decades. We're not advocating anything other than look at the data, and the month-by-month returns are telling. And the other part of that is advisor and allocator trying to figure out how these might fit in their own portfolio. They can look at the times in history where they wanted some level of diversification. They can also look at the risk tolerance that they might have. Not all CTAs have the same volatility level. To the extent you're willing to take on lumpier returns, to the extent your clients can take on deeper drawdowns or not. I think each advisor, each allocator has got to figure out what their risk tolerance is and which strategy makes sense for them.
The crazy thing, too, is that just the S&P buy and hold has lumpy returns and big drawdowns as well.
Oh, crazy lumpy. I just never understand how investors can withstand a 50% drawdown in equities, but if there's a 15% drawdown in a 15 vol CTA, that all of a sudden that's a crisis.
That's a really interesting point. What is that? Why can people just ignore the S&P? I've got my traditional buy and hold S&P. I'm in the index. People don't seem to have the same sense. There's a major disconnect there.
It's interesting. At some point, you try to understand it. You scratch your head. You try to say, oh, you have to diversify. And then at some point, the light bulb goes off and you say, rather than fight it, accept some level of that. We spend a lot of time saying, how do you address that? I'll tell you what we're doing about it. We're saying, look, we know from structuring, one of the things we do well here is product structuring. You don't have to give up your equity returns or your fixed income returns to get the diversification benefits. As you look at even just the CTA mutual funds, you don't need to, if you have $100 in the fund, you don't take $100 and put it with the Chesapeake. You don't take it and put it with Aspect. You don't put it with Campbell. Because of the way you access the returns of futures, you have a lot of cash available to invest in a number of areas. So we started out on a bespoke basis saying, look, institutional investor, you can keep your fixed income. So if you have $100, you can keep that in fixed income. Why don't you use futures to access the equity markets at whatever level you want, right? If you want to keep a 60-40, you take your 60-40 and say, okay, I'll take my $100, I can get $60 of exposure to equities through futures. You can keep 100% cash in fixed income. But then I think where the magic comes in, rather than fighting these folks and say, look, sell equities and sell fixed income to get managed futures, our solution is, and is better than or. Add CTAs, add diversifiers to the mix through an overlay. So you keep your fixed income, you add your equities, and then on top of that, you add diversifiers. You use an overlay. So rather than fighting this, you need to sell equities when you think equities are going up tomorrow, you keep the positive expectancy of fixed income, and you keep the positive expectancy of equities at whatever level the client needs or wants. And you say, okay, how much risk diversification do you want in an overlay? And instead of the opportunity cost of, let's say, 20% of the portfolio going to alts, you could add a 50% overlay. You could add a 100% overlay and manage the risk budget at whatever level the client's comfortable with. And so that, to me, is the don't fight them anymore. Let's try to help them keep what they really want to keep. And quite frankly, for most of them, it's keep what they're good at. So we've been taking that out. That's the thing we're most excited about around here. You know, we've done a lot of innovative things, but this is one where we know it's the right thing to do. And it really addresses this issue that you and I have talked about a few times already on this discussion.
You know, getting around those log jams of people and their inability to pull the trigger. Again, you're addressing that with your particular product, the overlay. In a perfect world, that 60-40 of stocks and bonds out there, in a perfect world, would it make a lot of sense to have some of that index money and stocks traded, for example, from a trend following perspective? I mean, in a perfect world, would that benefit investors more if their stocks were in a trend following mentality versus just the index mentality of like, I'll just set it, forget it. And if it goes up, that's fine. If it goes down, that's fine, but I'm not going to do anything.
Yeah, it's interesting. You know, if you look at the 60-40 crowd that you're talking about, if you look at the returns of mutual funds, because you're basically challenging the norm, saying, is that 60-40, set it, forget it, is that working? The vast majority of fund managers managing those 60-40 portfolios, or even those managing, you dial up the number, 100% equities or 85+% equities, almost all of them underperform the benchmark. Almost all of them underperform the benchmark almost every year. Should they do something different like you're suggesting? We think so. I mean, I just think it's crazy. You see these big funds, these big fund managers charging fees for underperforming the benchmark year after year. I mean, we're sitting around, and I know you like to be a little edgy at times.
Come on, whoa. Where I'm not edgy. Come on. I'm being very gentle today. It's like a root canal with plenty of Novocaine. Come on.
You know, you pull back the curtain and you get right to the issues. And we're sitting around, and at some point, we're saying things like, why the fee? They're charging these significant fees and they're underperforming the benchmark. So why the fee at some point became WTF?
You got to pick your fights is what you're saying ultimately. You need to run a business. You've got a good concept. You think you've got a good product. And ultimately, at the end of the day, given the landscape, you got to pick your fights.
Exactly. And also, how do we succeed in getting the marketplace to see that this is a better concept? You know that. You have been writing about this. And
over time. It takes time.
It takes a long time. So one of the things we're trying to do to get the attention is use this mantra of WTF, why the fee, whether it's an institutional bespoke portfolio or even the mutual fund we put out there. We're saying, look, we don't deserve to get paid unless we beat the benchmark. Seriously. You know, in the retail world, we're saying, look, if we don't beat the benchmark, we don't get our fee. We put it out there and we think, listen, there's resistance to getting out of just that 60-40 dilemma. And we're saying, look, we're so confident about this being a better way to do it. If we don't beat the benchmark, and the benchmark we're talking about, at least in the mutual fund, is the S&P 500 total return index. So this is it's a steep benchmark. But if we don't make it in the fiscal year, we don't get paid the next year. It's one way that, you know, trying to change behavior, trying to get the attention of the marketplace and saying, look, this is such a no-brainer. This is so much better than what's out there. We'll put our money where our mouths are.
This is the idea of starting any business is you go out there, take some chances. You see an opportunity, you try something. There's no guarantee necessarily, but you know, the idea of sitting still and just trusting the traditional way. Obviously, you guys are doing something different. So, I mean, that's to be saluted. That's what we want to see. We want to see innovations in finance and investments.
The innovation that we're seeing is that this whole concept of why sell equities and fixed income when they have positive expectancy, right? We know that there's resistance there. The innovation that we're seeing is add to it. And is better than or, right? Adding the diversifiers. And, I should qualify that a little bit, Michael. We do use a lot of trend, but we'll also put in some of the good trend followers that you know of have excellent hedging programs. They're just really designed to systematically hedge equities. They only turn on in certain conditions, kind of like trend following, but focused more on equity drawdowns as opposed to, including fixed income and currencies and physicals. Putting a basket of those together and adding it, that the power of and is what we're talking about with it. We think that's the coolest innovation that we see out there right now. And what it does to an overall portfolio over the long haul, it's adding benefits. Eliminate that opportunity cost we talk about. It's helping with better balanced portfolios, higher potential returns, because you have the return potential of the equities plus fixed income plus the diversifiers, which include a lot of CTAs.
I want to go into a few conceptual issues, good reminders, good ways of thinking, and I think contrasted to traditional ways. And I love this word forecasting. So many folks, everyone can flip on CNBC or Bloomberg and, every day, so many professionals attempting to forecast. And now it's gone on to Twitter. We have some of the biggest names in the world, media, finance, trading, investments, will be on Twitter all day long telling you their forecast. Whereas many of the investors, the fund managers that you work with, don't really work with that type of thinking. Perhaps some of the discretionary traders do, but more on the systematic trend side, we're talking about individuals that essentially say, we don't really know what's going to happen this year, but from an all-weather perspective, we're prepared. I still find, after all these years of myself being in this space, I still find those two different ways of thinking so interesting, because one is really just this gut level, trust me, and the other is something tangible, data, proof. And I find that contrast just still an amazing contrast after all these years.
Oh, and almost to the point where it's humorous, don't you think?
Yeah, there you go, right?
I have a couple anecdotes for you on that. Listen, I watch CNBC, and especially in the morning, I watch it when I work out, and I can't remember ever seeing a long-only equity manager tell me that the market's going down tomorrow. It's, we're going to move to a different sector, and we're going to underweight this and overweight that. I chuckle at that, and kind of the more funny thing is, years ago, when we first kind of got in the mutual fund arena, we did some PR. So we'd go on CNBC, we'd do the closing bell spots, we'd go to Bloomberg and Fox Business, while we would talk about diversification. And you can't miss with that, right? We know how this fits in with diversification, but we'd always get the question, what's going to happen tomorrow? Came in different forms of, hey, you do commodities, right? What's going to happen with gold? What's your position on gold? They don't want to hear, I don't know. It's funny, if you'd go to Mike Harris at Campbell or call Marty Lewick and say, hey, what's going to happen with gold tomorrow? They don't know. They have a model that has signals and it's systematic. Now, we do allocate to some CTAs that are discretionary. Before I go on some of these, I would call a couple discretionary managers and say, what are you seeing? And generally, these are the global macro guys that do have an opinion. But for the most part, I just smile and shake my head that how in the world do they think that we should know what's going to happen tomorrow on these?
You're lucky because you can go on CNBC and you can get that question and you can be very diplomatic about it. I can go on CNBC if that happens in the future. I can get that question, not be diplomatic about it, but I would create a video that would last forever.
It's funny with what our kids have to go through now. Yeah, things will last forever. You put it out there, you have to be careful, don't you?
Is there anything today, we've kind of touched on a lot of topics. Is there anything you want to bring up that just really, of all your years being in this space, something that, not a salesy type thing, but just is there a point that we haven't covered that you think is so important for everyone listening to kind of grasp?
This industry is run by some of the smartest people on the planet. It's remarkable to me. We talked about the aha moment with how diversified it is. And the other thing to me is it's the people. There's a lot of very smart, very thoughtful, high quality people in this industry. The opportunity for folks like you and me to interact with them it's remarkable. I feel like I'm super lucky. Every day I get to interact with some of the best and brightest on the planet, and I love that. And I think sharing that with your audience is a big deal.
So high quality that I would say for my own life, I've taken what these men and some women have taught me over the years, not only about trading, but other aspects of life. And I use that as a baseline, as a foundation. And so then when you see the cacophony of voices on a daily basis and someone's upset about this or they're fearful or paranoid about that, I've got the foundation where I just kind of say, okay. I mean, because there are tried and true ways that humanity unfolds. And I do think you're right that many of the people in the space that you and I touch on really have got some great ways of looking at the human condition. I remind myself every day how fortunate, how lucky I am to have come in contact with these people, because I meet other people that have not had these experiences. And it's almost like I have a secret decoder ring that I can't share with them because they've never talked to these people. They don't know who they are. They just don't get it. And I'm not saying that I'm all that. I'm not saying that I'm the most important person or anything like that, but I just feel lucky.
The people you've interviewed, it's remarkable. As I look at the laundry list and I've listened to some of the podcasts, Harry Markowitz. Some of the people that are just true legends. We've talked about a lot of the CTAs like Marty Lewick and Jerry Parker and so on, but you are fortunate. You're doing a great job with it. In addition to listening to the podcast, I'm looking right now, I'm sitting in my office. I've got a stack of 7 books of yours that I'm sending out to, I'll say customers, but they're friends.
7? My gosh, there's to be 77, 777. Oh my gosh, just 7.
It's a tall stack. It's a tall stack.
Hey, Bob, listen, great conversation today. Fun chatting. There's a lot of different areas we've touched on. Hopefully we've given people some food for thought, directions they can pursue. Is there a website where people can come to check you and your firm out? Where can we send people?
Oh, that's simple. EquinoxFunds.com. And somebody can Google Equinox Funds and they'll find our website. And once you're there, if you go one place, I'd say go to the thought leadership section. It's not commercial. It's really category driven. So there's a lot of what I think are really cool thought leadership pieces. There's cartoonesque vignettes about things like trend following, right? They're educational, but they're good for advisors perhaps sharing with their clients. And then there's more detailed pieces about the risk contribution of stocks that Dr. Ajay Dravid has written. It's a 3-part series, and it's eye-opening. Go there. If anybody goes there, go look at our thought leadership pieces. I just think they're educational. And you might even see a link to a couple of your podcasts.
Just to vouch for you, so some people might be thinking that's a sales line. The reality is, across this space, including your firm, with individual managers as well, the amount of free research and information that can be found, whether one becomes a client or not, is off the hook. So, if people want to learn, if that's still part of their desire, it is amazing how many people in the space that you occupy really do give away a ton of gray matter for free.
It's remarkable. Yes. You go to your website. Just think what you can learn from the multitudes of podcasts, the who is who in the industry that you've interviewed. It's crazy.
But I think that's the world for all of us today, whether it's myself or you. The reality is we're all building a relationship, and maybe something positive happens from that relationship. But that's the appropriate business building way today, I think.
Yeah, I think so too. And I think it has to occur in our category. It's really an educational play. If we can improve the understanding of the category, I think assets will follow, whether they're in our funds or others. But I just think if we can get the understanding level to a higher level, it'll help everyone in the category.
Bob, thank you for coming on today. I appreciate your time.
Thank you, Michael. Appreciate it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.